Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about TLT, the long bond, in relation to the yield curve. If you like this kind of content, consider leaving a like. Nothing in this video is financial advice, and probably end up being a longer video than usual. And so, if you've been paying attention at all in recent years to the financial markets, you'll certainly have noticed that there is a wide variety of usually reliable recessionary indicators that have failed. We had the Salm rule trigger in last summer. We had a lot of leading indicators that usually are a good barometer of where things are going, just give out false signals. If you think back to 2022, everybody was primed for recession because they were looking at a variety of indicators that were telling them that recession was more than likely until in 2023, with a lot of people hanging on to that view well into 2023. Those people are me. I was one of them. So just to put that out there. But in any case, jokes aside, we are still to test the yield curve indicator, particularly the 2 and 10 year spread. And my argument is that it will be sort of the last one standing when it comes to recessionary indicators. Currently, the spread between the 2 year and the 10 year is about 17 basis points. And we have come off of the lows, which we saw in the middle of January, of about 40 basis points. Now, the way you should really treat, if you're not familiar with all of this, the curve isn't all the same. Okay, so the central banks can adjust interest rates at the immediately short end. So think your bills, like with monthly maturities. But when it comes to the more you go out, the 2 year is basically the market's way of telling central banks where to position interest rates. There's a nice correlation with interest rates and the 2 year. Okay, wherever you have the 2 year go, more or less you have an idea of where central banks will position their policy. So again, the 2 year is really the market's way of telling central banks where to be. The more you go out on the curve, it's more of a reflection of growth and inflation expectations. So if there's the market is expecting more growth, so more inflation, you're going to have a higher yield. And the opposite is true. Okay. Now, why would it be the last recessionary indicator to stand? And why could it eventually be correct? Because why is it, well, first off, why is it considered a recessionary indicator? So historically, whenever you see the spread go negative, so below zero, and pop its head back over zero, so uninvert, generally speaking, in the near future, you usually see a recession. That is the basic argument. It's not when it inverts, it's sometime after the uninversion, okay? But again, going back to the original question, why would it be correct? And for that, I'll go back to the the quits rate. Okay. Now, the reason why I look at the quits rate, again, if you haven't watched my previous videos, the reason is quite simple. It gives you the best possible survey of labor market participants, okay, and what they are really feeling about the economy. Because unlike the surveys that you have, like in the conference board that came out yesterday, if I'm not mistaken, the University of Michigan surveys, they can all be biased by a lot of things, pardon me, especially political ideas, what happened in the news. A lot of things can go into someone's opinion. But if you're looking at what people are doing rather than what they're saying, you can kind of eliminate all of the noise and just look at the signal. Now, disregarding for a second what we saw post-pandemic, it's a real shame that we don't have the quits rate, any data prior to 2000, because I'd love to go back in time. But in any case, if the limited data that we have, what kind of a picture can you extrapolate? So prior to 2008, you had the quits rate go up and down. So an exuberant phase. Okay, so this is looking at 2001, just prior to the dot-com bubble and the 2001 recession, followed by a bust where people are feeling more conservative. They're not quitting their job, meaning, and that is the fact that people aren't quitting their job is a reflection of the fact that they don't feel as confident as they used to at the peak that they could find another job. So that in turn means, generally speaking, lower job growth, okay, and wage growth, pardon me, and a more conservative approach to spending, because things aren't abundant when you're at the lows, okay. When the quits rate is low, that is a signal that people are giving you, and they are saying that it's not the time to be a cowboy, okay. It's time to act defensively and hold on to what you already have. And after that, you have a boom and bust. That is really the trait that we saw prior to 2008. And even in the 2008 cycle, you saw the same thing. You had the quits rate rise, okay, peak out, and follow with a bust. Now, after 2008, leading up to the pandemic, you really struggle to find kind of this boom and bust phase. It's really a very, very slow grind higher, okay? Very slow. Now, what could you extrapolate out of that? Now, you might say there isn't a bust because, you had all this money printing during the 2010s, and that was basically central banks making recessions, illegal, if you wanna put it that way. But if you've read actually my one of my last articles I wrote, which is right here, I make the argument that central banks and public institutions in general aren't really in the business of predicting things, okay? The larger an institution, the more it is about reacting to whatever comes in its way. And to make my point, I take a look at the summary of economic projections that were published in 2024 and how they've changed a lot throughout the year because they had to react to incoming data. So if your starting view is that central banks really don't try to avoid things, they react to things. The premise that they were trying to avoid a recession kind of doesn't really have strong legs to stand on. I think, in my opinion, is that the fact that we didn't have really a boom and bust phase during the 2010s wasn't so much a symptom of the fact that central banks were trying to avoid a recession and we just went to grind higher. It was more a reflection of the fact that they were responding to weak growth. And if anything, this slow grind higher, to me, at least, just trying to extrapolate things from this data point, is that people were still trying to get over the trauma of 2008. And so what followed that was really just a long period of recovery. It was like a sleepy phase, let's say, if you want to call it like that. I've read other people refer to it as a silent depression. Generally speaking, the 2010s. One of the problems was low inflation and kind of sluggish growth. So again, I think it's more correct to say that you were in a phase where central banks were responding not to a potential recession, but they were responding to an economy that wasn't really moving. Okay, and we were in that state. At least the U.S. economy was in that state for a long time until 2020. Okay, so what happens in 2020? It's not a matter of do I feel like spending because of what happened in 2008. It was a matter of I can't spend anymore because the economy is shut. Even if I wanted to go out and spend my money at a restaurant, if I wanted to travel, if I wanted, go out for a burger, whatever the case, I couldn't do all that, any of that. And on top of that, you had stimulus get pumped into the system. So you had people with money and they weren't able to spend that money. So what followed from that point on is exactly what we got. We got inflation, first of all, because you had supply chains that couldn't stand the level of demand that was in the economy, and you had this time of abundance, let's call it like that, of excess, that is reflected with the job quits that spiked up towards 3% in 2022. Now, the reason why, and this comes back to why I think the yield curve will be proven correct, is that we are no longer in the post-2008 scenario where we have low growth and people generally unwilling to spend. Okay, this time here is more consistent with people saying, if the stock market goes up, say, I'll keep money aside because if 2008 happens again, I don't want to get cooked in the face of a sharp downturn. I'm going to save. I'm going to feel good, but I'm not really going to spend much of that extra income. The fact that we couldn't spend money in the pandemic kind of threw that out of the window. Okay, and whenever people got any source of extra income, people spent it because of the fact that it was because of the effects of the pandemic. We were all locked in a house, and that kind of fueled the desire to, again, to spend, enjoy life more, and splurge. And that is reflected with the quits rate going up. And to answer the question why the yield curve will, in my opinion, will be proven correct is exactly because of this, of what happened in the pandemic. We are no longer in this time frame here. We are in an economy that looks more like the pre-2008, where you actually have these booms and busts. You have excesses followed by more depressed phases. Now, of course, nobody here is calling for, doom and gloom. But generally speaking, if you have a time where people perhaps spending too much, what is reasonable to be expected is a time where people actually batten down the hatches and become a little more conservative. Okay. Going back to the yield curve, there's a lot of confusion, and I don't act like I have all the answers. Okay, this can definitely be wrong, but in general, you kind of have two levels that you should be watching: the 50 basis point spread and the 100 basis point spread. Because if you just look at when the yield curve uninverts, okay, the 2 and 10-year yields and uninvert, it's really hard to pinpoint the predictive capabilities of this indicator, because like in 2001 it uninverted in the beginning of 2001, and then I don't remember, it was 3 or 6 months later we actually had the recession kick in. In 2008 we had it actually popped over the uninversion in June of 2007, and then it actually started, if I'm not mistaken, in December or November of 2007. So it varies a lot, and it's difficult to find a specific kind of point of reference, okay, if you want to put it like that. So how can you really at least try and interpret the yield curve? So the 50 basis point spread, positive spread between the 2-year and the 10-year, and the 2-year, pardon me, is kind of your first yellow flag, kind of orange. Okay, whenever you see that spread widen to more than 50 basis points, that's when you have to ask yourself serious questions about growth. And if you look at 2001, generally this is, again, when you got to 50 basis points, that was a first yellow flag. 100 basis points is, kind of your game over. Something already happened. If you wanted to, let's put it like this: the yellow flag is something might be happening. The 100 basis point spread is something is something has definitely happened. And if you go and look at 2008, we breached the 50 basis points in September, finally got over it in November, and it actually reached the 100 basis points in January, okay, when we actually started getting the emergency rate cuts from central banks in again in January of 2008. Another thing I'd like to talk about, so before I move on, for this cycle we are at again 17 basis points, something like that, and we're still far away from 50 basis points. Okay, the fact of the matter is, though, that we are in an uptrend when it comes down to the uninversion. Okay, now there are many ways the yield curve can move around. And we've had kind of a few phases ever since the bottom in July of 2023. Okay, so just by looking at the first significant move towards the uninversion, so starting in June of 2024, we had this move right here, which was a bull steepening. Now, what is a bull steepening? Bull steepening is basically when the 2-year yield is falling faster than the 10-year. And so the curve steepens out because the front end is falling faster than the long end. So you actually have 10-year yields being higher than the 2-year as a result of the fact that they're moving down at the same time, but at a different speed. After that, we had kind of an intermittent phase that started in October and November. And this was kind of after the growth scare of the summer, where we started getting better news coming out from the labor market and other indicators, consumer confidence, ISM PMIs, and all that good stuff. What followed after is December and partially January, and in this phase we had a bear steepening. And a bear steepening is a steepening of the yield curve resulting from long-term rates rising faster than the short-term interest rates. Okay, so the 10-year is going up faster than the 2-year. So it is still making a positive spread, increasing the spread between the two, but it isn't as a result of falling rates. It's coming at the expense of rates going higher. Now, I think you could make the case that we are currently in a more of a flattening phase than anything else right now, and that is arguably why you've seen the spread go from 41 basis points to 17, 18 basis points, roughly 23 basis point move, because the 2-year isn't really moving all that much. Of course, we've had these past few days at least. Let me move to the daily. We've had a significant rally on the 2-year these last few days, but in general, the 2-year hasn't done much. Okay, right here, hasn't done much. On the flip side, long end rates have gyrated more. So going back to the spread, we're currently in a flattening phase where the 2-year is staying stable, and it is really a reflection of the fact that I would say the short-term uncertainty. There are a lot of things going on right now. There's kind of a fight between inflation expectations going higher and kind of trying to bring back in certain optimistic takes on growth. And I think that the 2-year is a great reflection of that. Also considering the fact that the Fed isn't really budging. They are acting in a way that is consistent with history, so being data dependent. That means they're going to wait for something bad to happen before they move, which ironically actually increases the chances of something bad happening. But in any case, what you've seen on the spread between the 10 and 2, looking at the monthly here, is a move up, pause, a move up, and a pause. And the nature of these moves up has been different each time around. I'll put the green to signal a bull steepening. And right here we've had a bear steepening, and I'll put it in red. And in between we've had sort of these pauses. I think right now is where we are in a pausing phase, and I think that of course we still have some data coming out this week. We have PCE coming out tomorrow, on Friday. We have initial claims coming out on tomorrow, and that can definitely move. But to get our next, to answer the question whether we're going to get a bear steepening or a bull steepening, or if things are going to stay more of the same, you really have to look at the next non-farm payroll print, which is due on March 7th, if I'm not mistaken. And if you've read the PMI report and basically every, labor market and generally economic indicator that has come out after, for the month of February has been not positive. So there is definitely the argument to be made that you could see a softer print to, to come out on March 7th. And if we do see a softer print come out, I think we could see the yield curve steepen. And my expectation, especially going out towards the summer, is that we will see a bull steepener like we saw last year, as we rotate from the kind of the expectation of inflation being the big star of 25 to potentially having to reevaluate growth expectations. And I'll close off with my last thing I wanted to talk about, which is actually the idea of having a strong labor market with just the idea that the labor market is strong just because initial claims are low and the unemployment rate is low. And if we pull up the unemployment rate, as you can see, it has ticked up. We've talked about my base case, but generally speaking, 4% is historically really, really low. Like really, really low. Something else we've seen to be really, really low is initial claims. Okay. Now, something I hear a lot is the economy is strong and we don't have to worry about growth scares because initial claims are low. Growth scares aren't really born out of initial claims going higher. Initial claims are kind of the last thing to, the last domino. Okay. If you're waiting for initial claims to explode higher, to say that we're in a recession, you're it's like waiting, imagine that you said, I'm not going to have a shower until I smell like rotten eggs. That's basically the same way of looking at things. The answer is you're already too late. Okay. Because by the time jobless claims definitely break out, something bad has already happened. And so you'll just end up like the Fed being late. Okay. Problems with growth aren't really born out of initial claims, as I said. They're really born out of hiring. Let me get this on the monthly. Okay. So what usually occurs before something going bad is a lack of hiring rather than firing. And it is during this phase here, right here, when hiring kind of starts to level off, that you see people kind of hold back a bit more. And this is actually what causes the quits rate to kind of peak. Okay, they're basically a mirror image of each other, because, of course, if labor market participants know that companies aren't hiring anymore, the most immediate response is, I'm going to try and keep my job, because I know I'm not going to be able to find a new job. Okay, so I'm not going to be aggressive and be and try to take risks. Okay, when it comes to increasing my pay. But really, problems with growth, again, aren't born out of layoffs. Layoffs are really the last symptom. By the time layoffs come, most likely the growth scare is already over. Okay, that is why whenever you see the unemployment rate spike higher, by the time it peaks, the recession is already dealt with. Okay, that is one of the reasons why you see the stock market actually bottom before the end, the real end of a recession, simply because this is just a manifestation of the problem. The problem is born right here, at a time where you should be acting in a more proactive manner, as I argue that the Fed should be doing, but you don't, for one reason or another. In 2008, it was more of a everything is fine, we don't have to worry, more of a vibe. This time around, it's more due to the fact that we have inflation PTSD. Okay, so we have inflation. Inflation being the number one worry. It is on everybody's mind this time around, and that is arguably what is keeping the Fed kind of sluggish on the rate cutting. But again, as I'm arguing, right now, even though it seems it is uncomfortable to cut rates, this is the time where you actually decide where you're going to go, in my opinion. Because again, if you're waiting for layoffs to come and the unemployment rate to go up to actually do something, all you're doing is you're really asking for some kind of growth scare. Okay, so that really is my view of everything. And again, if this were to come to fruition, so actually the Fed actually is late, that will actually just be more fuel to the yield curve uninverting with a bull steepener, which would be bullish for rates in general, as you'll see them coming down. Before I finish off, TLT had a pretty good I'd say 10 days. Honestly, I was quite surprised with this move yesterday. I'd still keep an eye on the day after tomorrow's data, PCE. It doesn't have to happen, as I said in the video I made on Monday, but I wouldn't be surprised if we actually saw some kind of a retrace on the back of PCE coming in a little bit hot, simply because we've really kind of front run a lot of the good news on PCE from on February 13th with the PPI data. that's really what I'm more worried about. I'm not so worried about this move right here, because this is really just a reflection of the fact that in the last few days we've really had to kind of reevaluate the growth outlook. Okay, so the slight hiccup I could see this week is coming from PCE. Apart from that, my general expectation, I've laid out numerous times in my videos, is that going towards the summer, even for just from a seasonal effect, is to see initial claims slowly grind higher. The forecast actually ticked higher. Yesterday it was 220, now it's 221. Again, my general expectation is for initial claims to slowly grind higher towards the summer, and again, it pays to keep an eye on anything that is a reflection of growth. Okay, I made my positions clear on inflation, and that is that if you're looking at inflation, you are most likely to be misled, because inflation has a very bad habit of going up into a recession. Okay, so if you look at 2008 as a perfect example of that, right here. Where is it? Right here. We had inflation go up to 5.6 in July of 2008. Okay, so that was in the middle of one of the worst times in history. We had inflation go up, and if you were to kind of base your judgment on the economy on where to position rates off of that, you would have been completely offsides in 2008. Same thing for 2001. You had it at near cycle highs at 3.2. Same thing for 1990, and of course they all had different reasons. Okay, like we have different reasons right now. Inflation is a feature and not a bug of the system. So just because inflation is slightly higher than where we'd like it to be, I think isn't a good enough reason to put more weight on the inflation side of the story. I think, especially given that we've had that that narrative be on the table for ever since the summer, I think that has kind of played out. And again, my general expectation is that towards the summer we'll have to reprice growth, and that'll come at the expense of yields. That is my base case, I guess. So hopefully I made my views clear, and I'll leave it at that. So again, if you enjoyed the video, consider leaving a like, and I'll see you in the next video. Bye.